I want to show you how to monitor what the market is expecting for interest rates. And I'm going to go to a website in a second called treasury.gov. But before we go there, let me briefly explain how the government controls interest rates. So let me first of all say that if you go to a grocery store and you buy avocados every week, and the price of avocados is usually $1, and you go there and they're $3, you're like, what's going on? And so what you do is you go to the store manager of that grocery store and you ask them, what's going on with avocados? And they tell you, well, there's a shortage of avocados. There's a bit of a drought where we buy avocados. We get them from Mexico. I live here in California. So there's a drought, for example. And as a result, there are fewer avocados and the price of avocados has gone up quite a bit. So what, Chris? Why are you mentioning this? Well, the process works the same when it comes to interest rates. So the manager of the store of money is called the Federal Reserve in the United States. In other countries, it's usually called the Bank of whatever, like the Bank of Canada or the European Central Bank or the Minister of Finance in Japan. And so what the government does is, just like with avocados, if they decrease the supply of money, then interest rates go up. Okay, and I'll explain how it works. It happens through issuing bonds. So governments don't make enough money every single year to be able to, make sure the economy is floating through taxes. They can't make enough money through that. So what they do is they issue bonds. And so here's an example. Let's say that you're a consumer in the United States or any country, or you're an investment firm. I'm the government. I'm the United States government, the Federal Reserve. And so what I do is I want to raise some money because I want to build a bridge, defend the country, etc. And so what I do is I sell you a bond. Okay, you take the bond. There's an interest rate on it, which is nice. You take the bond, and in return, you give me your money. I'm the government. And I use some of that money to build, bridges, defend the country, etc. And some of the money I take out of circulation. And so with part of that money out of circulation, just like with avocados, the price of money goes up. And that's how interest rates change. Now, the market is really worried these days, especially the stock market, because of interest rate hikes. So let me show you how we can monitor that together. And so there's something called the yield curve. And if you go to treasury.gov, it's a United States government website, and then we go here to data, we can look at what's called the yield curve. And this is where the market prices what it thinks interest rates are going to be. And so you can look at this data going back many, many years if you want to. For example, if we go back here to 1992, we could see, and I'll click go here, we could see here that rates were really high. Like the 30-year rate on January 2nd, 1992 was 7.46%, and the 10-year was about 7%, and the 2-year was 5%. Remember that number, 5%. So if we go back to today, current month, we can monitor what the market is expecting for interest rates. And so if we go to the most recent day here, as of yesterday, meaning January 26, 2022, and we look at the 2-year bond, okay, 2-year interest rates, we see that it's actually going up quite a bit. It's right now at 1.13%. And that's a big deal because at the start of this year, or on January 3rd, it was at 0.78%. And so that's a massive increase. The market is expecting the government to raise rates. Now, the government usually when they raise rates, they don't raise it by a massive amount overnight. They do it very gently. They raise rates by 0.25%, for example, which is called 25 basis points. And the market is pricing in that the government is going to be raising interest rates very, very soon. So what does this mean for you? Well, what this means is money's going to become more expensive for all of us, for everything. So when we get a mortgage to buy a house, the interest rate on the mortgage is going to go up quite a bit. And so what that means is fewer people will buy houses because the cost of money is higher, and therefore the price of houses will go down. It also means that a lot of people that borrow money to invest in the stock market won't be doing that anymore or as much because rates will be increasing. It's all about the rate of change, like in calculus class. And as a result of fewer people borrowing money to invest in the stock market, the market has kind of discounted that. That's why the market is down quite a bit, about 10% for the NASDAQ and the S&P 500 from the recent highs, which means market correction territory. And so, in a nutshell, the reason why the government has to raise interest rates is to make sure that the prices of all products don't go up and we don't have these supply constraints globally.